Welcome to Fearless Finances, where I try to take the fear out of your finances. Today, I want to talk to you about a little known secret that can eat away at your retirement savings or your college savings or whatever you might have saved up that you want to use in the future. The excerpt of the video that I want to show you that explains what can rob you of some of your precious pennies comes from a PBS Frontline called The Retirement Gamble. The whole thing is pretty darn good, so I'm going to link it in the description, the doobly-doo, below. But we don't need to watch the whole thing for this. We're going to keep this short and sweet. So I'm going to meet you on the other side and we'll talk about the secret thief that can steal your money. As you can see, this video is only about 4 minutes long. I might pop in just to chat a little bit about it, little things that come up. We might not even watch the whole thing.
To understand this fee business, I went to talk to someone who has thought long and hard about it. Jack Bogle, the founder of Vanguard, a company that offers some of the lowest fee products on the market. He says that if you want to improve your retirement outcome, make sure to minimize Wall Street's take.
Costs are a crucial part of the equation. It doesn't take a genius to know that the bigger the profit of the management company, the smaller the profit that investors get. The money managers always want more, and that's natural enough in most businesses, but it's not right for this business.
Just so you're aware of it, there's a lot of videos out there with Jack Bogle in it. All of them are excellent. It's like watching Warren Buffett tell you about money and investing. Jack Bogle was at it for a long time, and he tells it straight, and he makes it easy to understand. So he's a great resource to find out more about simple means to investing. But now that we know it's the fees, let's see how much it can cost us. Back to the video.
Bogle gave me an example. Assume you're invested in a fund that is earning a gross annual return of 7%. They charge you a 2% annual fee. Over 50 years, the difference between your net of 5%, the red line, and what you would have made without fees, the green line, is staggering. Bogle says you've lost almost 2/3 of what you would have had.
What happens in the fund business is the magic of compound returns is overwhelmed by the tyranny of compounding costs. It's a mathematical fact. There's no getting around it. The fact that we don't look at it, too bad for us.
What I have a hard time understanding is that 2% fee that I might pay to an actively managed mutual fund is going to really have a great impact on my future retirement savings.
Well, you have to rely on somebody to get out a compound interest table and look at the impact over an investment lifetime. Do you really want to invest in a system where you put up 100% of the capital, you the mutual fund shareholder, you take 100% of the risk, and you get 30% of the return?
How's that for short and sweet? You put up 100% of the capital, you take 100% of the risk, and you only get 1/3 of the return. Not good. Now, that, of course, is if your fees are 2%. There are options out there that can reduce the fees. In fact, what's very popular today is something called an ETF. As you can see, an ETF is an exchange-traded fund, and these do generally have lower fees than your standard mutual fund. Many of them are based in, say, an index fund. ETFs tend to be more tax efficient. They have passive management. They can look and feel very much like a mutual fund, but the expenses are far less. Whenever you're selecting a fund to invest in, look at the little box that says expense ratio. Certainly you want to get something that's going to give you a good return, but the expenses make a huge difference. In fact, Jack Bogle basically is telling people, just invest in the S&P 500. Now, I'll also say, depending on what Trump does going forward, a lot of people and a lot of institutional investors, people who are savvy and wise about all of this, are moving more into international funds. I recently just moved into a European index fund and the Nikkei. I think that's how you pronounce it. It's like the most common Japanese index, the Nikkei. Because if Trump really moves ahead with these tariffs, our economy is going to go through a long-term shakeup. And I'd rather not be part of that. So I think it's worthwhile to check back in with Jack and our reporter, because they're going to end up shedding a little bit more light on this whole fees thing.
I wanted to know how others would react to Bogle's claims. J.P. Morgan Chase offers more than 100 mutual funds that charge anywhere from less than half of 1% to more than 2.5% annually.
I want to get your reaction to an example that Jack Bogle gave us, and that is that if you invest over a 50-year investing lifetime in a mutual fund, making 7% a year on average, but you're paying 2% in fee for that, that 2% will erode something like 2/3 of your gains.
So the lower fees relative to any given investment will always result in higher accumulation.
But is his example correct? I mean, it's shocking that you would be giving up 2/3 of your...
So I don't know the math behind the example.
But does it sound correct?
Citing. It sounds high.
It had sounded high to me as well, so I took Bogle's advice, found a compounding calculator online, and used a simple example in order to isolate the effect of fees. Take an account with a $100,000 balance and reduce it by 2% a year. At the end of 50 years, that 2% annual charge would subtract $63,000 from your account, a loss of 63%, leaving you with just a little over $36,000.
Well, there you go. That's pretty darn significant. And I'd also like you to consider this. And this is one of the problems with fees, whether they're in our fund investments or it's something that we're paying to a financial advisor. We're paying those fees whether our earnings are going up or not. So as our account value is going down potentially in a correcting market, we're still paying the 2% out or the 1% or the 0.5%. So the lower we can get those fees to be, the better off we are in the long run. Again, I'm going to put the link for the full retirement gamble down in the doobly-doo, the lovely little description. It was produced maybe about a decade ago, but it does give good information about planning for retirement and how people can get caught in the mix. There's particularly 2 teachers in there whose account value had gotten up to $1 million, and then it went down to 300,000. Ouch. Well, again, this video was intended to be short and sweet, so there you go. Watch your fees. And the reason why is you can lose a lot of pennies. Super important. If you'd like to get more fearless with your finances, I encourage you to subscribe to this channel. I'll be here giving out other good information. And if you'd also like this video, it'll ensure other people get it. And if you've got any questions or comments for me, please feel free. In fact, I'd like to know if you've done any changing to your retirement strategy or your investment strategy since Donald J. decided to mix things up with the tariffs and the other stuff in our economy. And if you'd like to learn more about what I decided to do, I suggest you click one of these 2 videos. One is when Donald J. first got into office and I reorganized my investment strategy. And the other one is how I updated it after the tariffs. And I'll see you there.